bring on our next presenter, who is Erik Hayden with Urban Catalyst. And I was speaking with somebody, I don't know, a couple weeks ago, and I mentioned that Urban Catalyst was presenting, and they thought, "Oh, I thought they were done with their Opportunity Zone fund. I thought they closed their fund already." But then they did. They did close their fund, and now this is Fund 2 that they're going to present today. So, Erik, what's going on, man? How you doing?
Hey, Jimmy, good to be here. Excited to present today. Yes, Fund 2. We opened Fund 2 in January of this year. We closed our first fund at the end of December of last year.
And you raised a lot of capital for that first fund. I think you exceeded your expectations, if I'm not mistaken. Is that right?
That's right. We were oversubscribed. We raised $131 million in our first fund from 356 unique investors.
Excellent. And that was a multi-asset fund with different property types of real estate concentrated in San Jose. This fund is a little bit different. So let me just turn it over to you, and you can take it away with your presentation, please, Erik. I haven't seen this one yet, so I'm looking forward to this one.
Excellent. Me too. All right. So Urban Catalyst, here we are in Fund 2. We were very successful in our fundraising for Fund 1. Fund 2 is very similar. We are a real estate equity fund focused on doing ground up real estate development projects in downtown San Jose, California. We're also an Opportunity Zone fund, which allows us to give those tax benefits to our investors. And really, just to get us started, we've been featured pretty prominently in the news here in San Jose over the last couple of years. We've had over 175 news articles written about us. Really just a lot of positive buzz about what we're doing here in downtown San Jose. Probably most important of that, we were named by Forbes magazine as one of the top 20 Opportunity Zone funds in the country. National validation from Forbes about what we're doing is always a good thing. And I'm sure a bunch of the other presenters have covered this, so I'll go through it pretty quick. But in order to get the tax benefits associated with this program, you have to invest capital gains. These are the three most common types. Always like seeing your survey, Jimmy, about the folks on this webinar as to what their capital gains event was. For us in our first fund, the majority of our investors, the sale of stock was their capital gains event. You get three primary benefits, and I'll go through these pretty quick too. You're able to defer paying capital gains on your initial event until 2027. When you pay those taxes in 2027, you get a 10% reduction. So for every $100 that you would have owed in taxes, you only have to pay $90. And these are great benefits, but it's really the third benefit that is the most important, which is after an investor's money seasons in an Opportunity Zone fund for 10 years, all of the profits from the fund itself are tax-free. So here at Urban Catalyst, our plan is to build these ground up real estate development projects in San Jose, lease them up, stabilize them, hold them until we get to that 10-year mark, and then sell all of those assets, liquidate the fund, and that's when we return the majority of the profits to our investors. Just taking a step back here in the Bay Area, these are the Opportunity Zones. You can see them in green. For this fund, we're focused in San Jose. So here's a close-up of the San Jose Opportunity Zones. And what is unique about this is almost all of downtown San Jose is covered by the Opportunity Zone. It's one of the best Opportunity Zones in the country right here in Silicon Valley. It's interesting, when I started Urban Catalyst, my plan was to start just a regular real estate equity fund to focus on doing ground up development projects in the downtown area. And that's really because of the overall macroeconomic trends throughout Silicon Valley, all pointing towards downtown San Jose as the next place to do development on a large scale. And it was only after I started forming Urban Catalyst that I learned about the Opportunity Zone program and thought, boy, wouldn't it be great to be able to give my investors these tax benefits associated with this program? So that's how Urban Catalyst became an Opportunity Zone fund. And what makes Urban Catalyst different than most other Opportunity Zone funds is we're not just fund managers, but we're also the developers of all of our projects. We've been developers here in the Bay Area for quite some time. And whenever we do development anywhere throughout the Bay Area, there are three things that we look for. And downtown San Jose has all three. The first is we want to make sure there's a demand for all of the different types of projects that we're building. And in downtown, that demand is really driven by that Silicon Valley job engine. We want to make sure that transit and physical infrastructure are already in place. Downtown San Jose really is the only true urban environment in Silicon Valley. The Diridon train station is slated to be the largest train station on the West Coast. It already has a variety of mass transit options that connect to it, including Caltrain. And now BART will be connected. It's fully funded to come through downtown San Jose, connecting into Diridon Station. For those of you that aren't aware of what BART is here in the Bay Area, it's the largest mass transportation system. It's a medium gauge rail system. It's been in existence, for over 60 years, and now it's finally connecting all the way from San Francisco to the East Bay down into San Jose and Diridon Station. And then you really can't talk about downtown San Jose without talking about San Jose State University. It's located right in the heart of downtown, and with over 35,000 students, it's the second largest university in the Bay Area behind Cal Berkeley. And last but not least, we want to do business in a place where the local government wants to see development happen. That is not the case in most California cities. It is really a challenge to get your building permits, but here in downtown San Jose, they've really streamlined the process and made it significantly easier for developers like Urban Catalyst to do business. This is a picture of my partner Josh and I with the mayor of San Jose, Sam Liccardo. Sam's been the mayor for 7 years. Before that, he was the council member representing downtown for 8 years. And it's really the policies that he's put into place that have streamlined that process. To talk a little bit more about downtown, I thought I'd show you this map of downtown San Jose. This black line represents the opportunity zone. Our headquarters here at Urban Catalyst, we're located right here in the heart of the zone. We're local developers, boots on the ground. We're right next to Adobe's world headquarters and Zoom's world headquarters. Here's San Jose State University, as I mentioned, and here's where that new BART line is running, right down Santa Clara Street, which is really the main drag here in San Jose. A couple of stops downtown, then connecting here into Diridon Station, that big train station. The real big news in downtown San Jose development over the last couple of years has been Google. Google has acquired over $450 million worth of property here in downtown just in the last 24 months. The plans that they've submitted to the city, which are almost approved, are for them to build roughly 7 million square feet of office and over 6,000 residential units. At build out, this will be Google's largest campus on earth. A lot of folks here in downtown, we call it Google's mega campus because as far as the number of folks that come to downtown San Jose, this campus will almost double the population every single day. But Google's not the only group that is coming to downtown. We've also seen big developers acquiring land. Jay Paul there in purple, he's a regional Bay Area developer. In the last 2 years, he's purchased $650 million worth of property. His plan is to build almost 5 million square feet of development. West Bank there in green, they're a Toronto-based development company. In the last 6 months, they've purchased $300 million worth of property. And really the reason why I'm showing you other developers coming into downtown and big tech companies is because here at Urban Catalyst, we saw this wave of development coming to downtown. And our plan was to get in on the ground floor, acquire properties before all these other developers and big tech companies just gobbled up all of the property. And that's exactly what we did with the acquisition of our Fund 1 and Fund 2 projects. I talked with Jimmy a little bit about our Fund 1 projects earlier. We have 6 projects in that fund. You can see them here in blue. We have some diversified asset classes. We have 2 office projects, a senior living facility, an extended stay business hotel, 184 unit apartment building, and a high-rise student housing project for San Jose State. So these were our projects in Fund 1. I'll just reiterate, we raised $131 million in Fund 1, almost $65 million a year on average. Plan to just continue that momentum into Fund 2. So for Fund 2, we've acquired this property. It's here in orange. It is a 2-acre site. We're building 2 high-rise projects on it, and I'll show you those here in a second. These are the projects in Fund 2. It's very unique to be able to acquire almost an entire downtown San Jose city block, and this is really an ideal location across the street from City Hall, next to a future BART station, right on the main drag in the Central Business District. Our project for Fund 2 is called Icon Echo. Icon is this office building here right on the corner of 4th and Santa Clara. Echo is a 300-unit multifamily apartment building. And I'll talk about Echo first. And, really from a demand perspective here in Silicon Valley, we can't build multifamily fast enough to meet that demand. We've created 5 jobs for every housing unit that we've built in Silicon Valley for over 30 years straight. That has caused the price of single family homes, of condos, apartments, really all residential categories to be some of the most expensive in the world. In fact, a lot of folks here call it a housing crisis. So we're building multifamily, extreme demand for multifamily. Now, when we talk about office, and this is our office project here from a different perspective, on the corner, this is the Icon project. It's 420,000 square feet of office. Office has a different demand profile. Silicon Valley, we can build office fast enough to meet the demand. I mean, there is a lot of demand for new office space, but there's also a lot of supply. So when we build new office, we have to make sure we really hit 3 categories as far as the project location and design. And those are, we need to be in the best location. Downtown San Jose, main drag, next to a BART station, really the epitome of transit-oriented development. This is everything that a big tenant is going to be looking for from a location perspective. We want to make sure it's functional, so it has the best functionality possible. And when I talk about that, that really means we have the correct parking ratios, which we do. We have the perfect 40,000 square foot floor plates that all the big tech tenants are looking for. And we have that 14-foot floor to floor height. We're delivering this cold shell to our future tenants, and it's important that we are able to deliver them everything that they want. And then finally, the last thing, we want to make sure that it's an aesthetically pleasing building, that when a CEO that's going to locate their company here sees the building, they think that is a beautiful building that we want to live in. We've hired WR&S. They're one of the best architects in the world at designing office. And this is our initial rendering. I only anticipate this getting better from here. So that is our Icon and Echo project. I mentioned a little bit about what makes Urban Catalyst different is that we're also project developers, not just fund managers. And most opportunity zone funds out there, they are just fund managers, and their plan is to go out, raise a bunch of money, and then look for developers that have projects located in opportunity zones all over the country that they can partner with. Here in Silicon Valley, we look at Steve Jobs and Steve Wozniak, we think, did these guys go out, raise a bunch of money, and then hire someone to build them a computer? And the answer is no. They built a computer and then they took it out to the market. That's exactly what we're doing here at Urban Catalyst. We're not a blind pool fund. We have 2 projects, multifamily and office, and now we're taking those projects out to the market to finance them. And a lot of folks that look into investing into opportunity zone funds, they hear about the tax benefits and they think, boy, amazing tax benefits. And, obviously we're big fans of the tax benefits here at Urban Catalyst, but what really matters when you invest into an opportunity zone fund is the underlying real estate. Because if the biggest tax benefit that you get is tax-free profits after 10 years, there better be profits after 10 years, or really what's the point of the whole program? So understanding that underlying real estate and who the developers are that are building your real estate is really important. Here at Urban Catalyst, we see ourselves as a solid fundamental real estate equity fund, and then we see the opportunity zone tax benefits really as just the icing on the cake for our investors. To talk about Urban Catalyst and our development team, I'll start with myself. I'm the founder of Urban Catalyst. I've done several $1 billion worth of real estate development projects here in the Bay Area, a significant amount of that in San Jose. In general, I build institutional quality and scale projects. When I started Urban Catalyst, my plan was to create an all-star team of downtown San Jose developers. I brought on Josh and Paul. I've known both Josh and Paul for over 10 years. They have significant development experience. Josh worked for a group called Barry Swenson Builder for 12 years prior to joining Urban Catalyst. He was their lead developer. He managed their entire downtown San Jose portfolio, which is quite extensive. He got experience building a variety of different asset classes. Paul is our executive vice president of development and construction. For 15 years prior to joining Urban Catalyst, Paul was the lead developer at the Core Companies. He focused on multifamily and below market rate housing in downtown San Jose. And Paul leads our team of 12 development and construction professionals that build all of our projects. Of course, we're not just developers, we're also fund managers. Morgan Mackles, I've known Morgan for over 25 years. He and I went to high school together. in general, Morgan has built scalable and repeatable processes throughout his career from a sales perspective. As our head of investor relations, he's the primary reason why we are so successful, in our Fund One fundraise. And then, of course, we have Sean Raft. Sean is an attorney. Sean manages our legal teams, our financial consultants, our accounting teams that do our tax and audit, and our fund administrators. Sean's also on the national working group that advises the Treasury and the IRS on any ongoing opportunity zone clarifications or legislation. And an easy way to say it is Sean really dots the I's and crosses the T's here at Urban Catalyst. So this is the development team. Throughout our careers, we've done over $5 billion worth of real estate ground up development projects here in Silicon Valley. You can see the heavy concentration of projects in downtown San Jose. Now this is what investors really want to hear about, which is the timeline of our fund. So I wanted to go through this in a lot of detail and spend a lot of time on this. For this fund, we're raising $200 million. We're going to take that $200 million, match it up with senior debt, and build the project. So in general, the project is roughly, it's a $600 million project. So we're utilizing around 65% loan to cost. We have a 3-year fundraise. I mentioned we'd raise $65 million a year in our first fund. As this is a $200 million fund, we are conservatively estimating that we'll raise that money in 3 years. I will say that in our first year, we raised $50 million. And that was, we didn't have all of our projects identified. In our second year, we raised $80 million, and that was in the middle of COVID. It is possible that we will not have the fund open for the entire 3-year period. We'll close it early when we hit that $200 million mark. Our minimum investment size is $250,000. That was the same in our first fund. In our first fund, we averaged just under $400,000 as our average investment size. Just wanted to point out here in 2027, here's when you pay your taxes on your initial capital gains event. And then after 2034, this is when we plan to sell those properties and return the majority of the profits to our investors. Now, I get a lot of questions. Are you planning on making distributions to investors prior to the end of 10 years? How much? And will that be enough for me to pay my taxes in 2027? And the short answer to both those questions is yes. We do plan on making distributions prior to the end of 10 years. The first time we do that is through our refinance and distribute program. And the way this works, sometimes I call this developer 101 because it's very typical from a ground up developer perspective. We're starting the projects here in 2022. We're starting construction. Those projects will be completed here at the beginning of 2025. We'll lease them up, we'll stabilize them, and we'll go out and get permanent financing. We take that permanent financing, we use it to pay off the construction loan that we utilize to build the buildings. And then any excess refinance proceeds, we're able to pass those through to our investors tax-free. Right now, we are targeting distributing 65% of our investors' initial investment back to them in 2026. And that should be more than enough money for our investors to pay their taxes in 2027. Of course, the caveat, nothing is guaranteed in investment into a fund like ours. There are risks associated. I'm sure my attorneys want me to bring that up whenever I talk about forward-looking statements like projected returns. After our refinance and distribute, we'll have these stabilized assets and our fund becomes more of a core fund where we are distributing cash flow to our investors until we get to that 10-year mark when we can sell the properties. One nice thing about Urban Catalyst and our structure is the fund is an LLC, and that allows us to pass through losses to our investors. And let me tell you why that's important. Just like any real estate owner, we'll have depreciation on our assets. That depreciation is typical. People write that off on their tax returns every year when they own real estate. We're going to do the same, only we're going to take that depreciation, pass it through to our investors as passive losses. That passive loss should be so significant that it offsets all of the cash flow that we'll be distributing, throughout the duration of the 10-year hold. In fact, we did a cost segregation analysis in our first fund. In our first fund, for example, if you'd invested $1 million, we planned on passing through roughly $220,000 in cash flow over the 10-year hold. We also planned on passing through roughly $950,000 in losses. So significant losses, and that's a great thing, right? You're able to use those losses to offset other passive income. But then the real, call it cherry on top, and this is specifically for opportunity zone funds, is that here at the end of 10 years, when we sell our properties, there is no depreciation recapture. So typically, if you own those buildings and you sell them, you have to pay back all that depreciation. For opportunity zone funds, this is part of the December 2019 final guidelines. There is no depreciation recapture. In fact, that passive loss that we've passed through that carries forward forever, that's been rolling up for our investors, it converts from passive loss to active loss and can offset things moving forward for our investors like ordinary income. And that's awesome because ordinary income typically a pretty high tax rate. So that's how we put everything together. We have tax-free distributions from our refinance event in 2026. We have tax-free cash flow and then tax-free profits from the sale after 10 years. And that is my presentation, Jimmy. Of course, if you want to learn more about Urban Catalyst, please visit us at urbancatalyst.com.
Excellent. Well, thank you, Erik. Thanks again for joining me. He was one of the presenters on OZ Pitch Day 2020 back in November. He loved it so much he came back, like several of my other qualified opportunity fund partners did. So very pleased to hear from you, and congratulations on closing Fund 1. And I'm sure you're looking forward to where Fund 2 will take you. We do have time we'll do about 10 minutes of questions, actually. We got plenty of time here before our next presentation. Before we do get to the questions, I want to let everybody know that we are going to be reopening those fund breakout sessions again in 10 minutes as soon as I kick Erik off stage. And Urban Catalyst has a breakout room there where you can meet one-on-one with Erik. Actually, it won't quite be one-on-one. There'll probably be a couple other dozen people in there or so, but it's a little more intimate way to get some FaceTime with Erik and pose your questions directly to him. But first question here, let's see. Jay wants to know, if we invest in California, do we have state tax liability for our current capital gains? California being one of the states that does not conform to the OZ benefit.
That's correct. California does not conform to the federal guidelines. However, when we talk about this in general, I get a lot of feedback from folks in other states about California. The reason why we're here in Silicon Valley's market is just fantastic. In general, it's the last market to go into a recession and one of the first markets to come out of a recession. What we've seen here recently in Silicon Valley, which is kind of interesting, is a significant number of office sales, existing office, and for record or near record pricing. Now, that isn't something I would typically expect when a lot of folks are concerned about the work from home phenomena and all of that. But why we're seeing that here is we're seeing all of these institutional REITs and large equity groups focusing on acquisitions here in California because they see this as the safe harbor. If they have to invest anywhere in the country, they want to be right here in Silicon Valley. Now, that's a long way of answering your question to say, we have great projected returns for this fund. I don't want to go into them because I don't like discussing forward-looking statements. We do raise money through the broker, dealer, RIA channels, and they are subject to FINRA guidelines. But what I can say is our projected returns, I'm a fan of them. And you can think of it like this. You could pay that additional 10 to 13% on a $500,000 profit, or you could not pay it on a $100,000 profit. And really, that's the real difference, right?
Good answer there, Erik. Thank you. Another quick question here from Mitch. He wants to know, any possibility of lowering your $250,000 minimum?
The answer is no. We have a pretty hard line in our $250,000 minimum. So unfortunately, 250 is that line. Now, the thing about opportunity zone funds, a lot of folks don't know, is we also accept just regular money. You don't get the tax benefits associated with the program, but you do get to invest in great real estate development projects in San Jose.
Good answer there, Erik. An anonymous attendee asks, I got to turn off the anonymous stuff. I like having the names there. Is there pref returns monthly with Urban Catalyst?
So we're not like a REIT that has stabilized assets that's going to be giving, a certain return every month or every quarter or every year. Our returns and distributions are really event driven, and the big events being the refinance of the properties and the sale of the properties. And then whatever cash flow we have over that 10-year hold, plus those losses, we'll be passing those through to our investors on a quarterly basis as we have them.
Good. Paul just chimed in. He just wanted to say great presentation. Let's see. Another question here. You said return capital via refi tax-free. How is that possible if you do that before 2026? Investor
Oh,
deferred capital gains into the OZ fund. So if you take it out early, I would assume that triggers the call or the capital gain tax. Am I wrong?
he is wrong, and it's because of our structure as an LLC, we're able to pass through debt. So because of our structure, we can do that refinance event and pass through those proceeds tax-free. One of the major reasons why we're structured the way that we are. And I'll tell you, Jimmy, early on in the program, when we first formed in 2018, they hadn't had the 3 rounds of clarifications, and it was, a little bit confusing as to whether an LLC structure would work for opportunity zone funds. But after the final guidelines in December of 2019, it was very clear that an LLC structure is the preferred method to structure an opportunity zone fund, and specifically because you can pass through debt and you can pass through losses.
Good answer. That's a key distinction there, and a good question. Let's see here. Clint wanted to just mention, he was a presenter previously. He wanted to say, hey, good on you, Erik, for bringing up no depreciation recapture. It's a great deal, and it's not spoken nearly enough about. In real estate, it's a key return component. So that's a very important part of your deal there.
I thought when the December guidelines came out in 2019 and I saw that no depreciation recapture, I thought, oh, this is going to be front page news of the Wall Street Journal. And then I didn't hear anything about it. I mean, we were doing a little dance here in the office. I mean, how amazing that we're able to give our investors this additional benefit. I mean, that should be, everybody talks about the 3 main benefits of the program. That should be the 4th because it is so significant.
Yeah, I call it one of the hidden benefits of opportunity zone investing. I wrote an article about it about a year or so ago, I think, maybe after those final regs came out. Pei asks, if mixing capital gain with ordinary investment, can the additional investment be gain tax free after 10 years?
The answer is no. Regular money doesn't get any of the tax benefits associated with the program. But it would be nice if you only had, say, 225,000 and you want to meet the minimum, you put in that extra 25.
Yeah. So the way it would work then, the way it would work then is you bring in 250K, but only 225 of it is capital gains, and the other 25 is just regular cash. You're basically you're receiving the tax benefits just on the 225K portion. Is that correct, Erik?
That is correct. And we had some investors, I'd say a handful of investors in our first fund that didn't have a capital gains event, and they just understood the San Jose story, knew us as developers, and wanted to be a part of the program. I mean, Silicon Valley real estate from a ground up development perspective, our returns don't necessarily change just because we're an opportunity zone fund. We still have to have the same return hurdles that any other developer here in downtown has. And so the only major difference is that we have an extended hold. Instead of selling in, say, like year 5 to 7, we sell in year 10. And that changes your returns. Obviously, holding longer lowers your internal rate of return a little bit, but it also increases your multiple.
Good. Got time for 2 or 3 more questions, and then I'll cut you loose, Erik. And again, appreciate you joining me today. Dana asks, how do you handle the conflict of interest between the asset manager with developer, assuming they are one and the same?
I never really looked at it as a conflict of interest from asset manager to developer. I mean, and I think the question really is fund manager and developer. It's more that we don't charge, like a pref or we don't have a return hurdle for the developer at the project level. And this is kind of one of the nice things about being a developer and a fund manager is we don't have that double return. So it's, we have fees at the fund level, but at the project level as a developer, we don't give ourselves any preferred treatment. We don't get like a bonus when the project sells if it hits a certain, internal rate of return. It's more of we are at the fund level, but we're also just the developers as well. And that allows us to control a lot of the things like especially associated with this program, like substantial improvement, knowing what the returns actually are instead of having a development partner and hearing what they say the returns are, so that we can really have boots on the ground and feel these projects to make sure that they're right for our investors.
Very good. Chet wants to know, what is your fee structure? Is it an incremental waterfall in favor of the investors? Are you always the developer? And what are your development fees?
That's a great question. So our fee structure, we're a pretty typical 2 and 22% management fees per year. And then after our investors receive their money back plus a 6% return, we have an 80-20 split. That really happens in year 10 when we sell all the assets. At the developer level, we have fees that are pretty typical for developers. We have a development fee, acquisition fee, disposition fee, and a finance fee.
Fantastic. I think we've got time for one more question here. We've got a whole lot of them coming in. We always get a bunch of questions coming in last couple minutes here. Let me see if I might pick out two more. Clint wants to know, Clint's been great. He's been here all day asking questions and answering questions. He says, it took us a while to figure out depreciation. He's a fund manager with the Nest Opportunity Fund. He wants to know, was Urban Catalyst able to figure out the at-risk basis issue upfront for investors' ability to take initial depreciation losses?
Clint, that sounds like a question for my accountant. I'm not
I
sure.
was thinking the same thing. I was hoping you would understand that question.
Yeah, why don't we table that question to the breakout session, and I'll find out the answer for that.
Good idea. Good idea. Let's see if we can have one more here. Here's one from Himanshu. He asks, how do you feel about the tech exodus happening from Silicon Valley right now? How does that impact new developments like yours?
Sure. So a lot of stories in the paper about tech exodus, right? I'm going to give you a little bit of a stat to give you an idea of what's really happening here, because it isn't really as significant as the papers are pointing it out, which is, the big news was that Oracle decided to move their headquarters and HP decided to move their headquarters, and Elon Musk moved to Texas. So Elon, billionaires moving to Texas, that's nothing new. Oracle and HP, a little bit past their prime as far as, the life cycle of tech companies. But just to give you my stat is, companies here in Silicon Valley that went public just in Q3 and Q4 of 2020 in the middle of COVID, their market cap was larger than Oracle and HP combined. So just to give you an idea, there's still just a monstrous amount of new tech companies that are constantly starting, going public here in the Valley. Another way to look at it is, we have a 10-year fund here, right? We have to wait to get those tax-free profits. And Silicon Valley, will Silicon Valley be Silicon Valley 10 years from now? And the answer in general is yes. We still have more tech workers than any other location in the country. We get more venture capital funding than any other location in the company. And we have 5 of the 7 largest companies in the United States have their headquarters here. So you put all that together, and those are the ingredients for success in Silicon Valley.
Fantastic. All right. Well, thank you, Erik. I think that does it for our time. Clint did just chime in. Sorry, I'm a nerd. So hopefully we'll get the answer to Clint's question in the breakout session.